This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's move on to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Louis' picture saying, looking for the downloads. Now, Eric, let's move to the crude oil chart here as well. How did the EIA inventories come in?
Crude oil drew down 1.2 million barrels. Finally, a drawdown as we come out of refinery maintenance season and into the time of year where we can start to expect more drawdowns to occur. I think it was probably the winter storms, the December storms that were causing that series of builds to occur unexpectedly in January as that took some refining capacity offline, but it seems like we've recovered from that now. Cushing, Oklahoma drawing down 890,000 barrels, almost a million there. Gasoline drawing down 1.1 million barrels. Distillates was the only build on the board at 138,000 barrels. U.S. production down 100,000 to 12.2 million barrels. Really feels like U.S. production has plateaued. We saw a very rapid recovery after the COVID pandemic, right back up to 12 million barrels, something that a lot of people thought was impossible. It happened, but it seems like we've hit a wall here at just over 12 million barrels. Tape action was up after the build on inventory, but that quickly retraced to the downside. And it seems like we do have a new downtrend beginning. Now, just to clarify, we finally got a bullish signal on Monday, which was a daily close over the 100-day moving average on the continuation chart. That would have been an extremely bullish sign if it had held, which it didn't hold, because that was only the second time that we had a daily close over the 100-day since July of last year. So it seemed like maybe that was a strong bullish signal, but it turned out to be a fake breakout after all. In fact, we only spent a few hours over the 100-day moving average, and then as Jay Powell took the stage with more hawkish than expected commentary from the Fed, all assets started to dive at that point. That also caused the slow stochastics to roll over. We're now below the short-term moving averages, so it looks like we're now seeing a new leg down that has begun. Despite all of what Louis and I discussed, and when we recorded that interview with Louis, we were still above the 100-day moving average, felt like maybe a bullish breakout was occurring. But it's now confirmed really the sentiment that Louis and I discussed, which is despite the fact that there are several bullish long-term factors, feels like the market is a lot more focused on the coming recession risk than geopolitical demand or China recovery or anything like that. The last time we had a move above the 100-day moving average, which was only intraday, was on November 7th, and that began a $22 slide all the way down to $70, 70.08 actually. A similar move here would take us all the way down to 58. Now, I don't think we're going all the way to 58 unless we get some really bad recession news. But I do think that another leg down, if we get below 70, could take us right down to $66 or so, which is where the 200-week moving average is. My conviction has not changed that the global economy cannot go back to pre-pandemic growth trajectory due to lack of oil supply. But I'm coming around to the view that growing expectations of a second-half recession could bring prices significantly lower from here before we get that economic recovery. It's really on the other side of a recession where my scenario or my hypothesis comes into play, saying I don't think that we can recover completely from that recession. But if the recession is about to happen, that could certainly bring prices even lower.
Well, you know what's interesting, Eric, on this chart, I put that 200-day moving average on there, and it just continues to show that the primary trade range consolidation of crude is certainly occurring at the bottom end of its ranges and below all of its averages. We did have that key test of that overhead resistance of the trade range, but clearly there is a lack of conviction to take crude oil out of this trade range, at least yet. If we see a breakdown here that heads all the way back to its previous lows. My spidey senses are thinking that they might even temporarily break it one time below to a lower low just to kind of wash out stop losses and kind of clean the market out a little bit before any potential reversals. In my mind, the only way the bulls are really going to see a turn in this is if we see that the pattern of dips being bought at higher lows and working their way up towards the top end of this range, which conveniently would have a breakout of the 200-day moving average when inevitably a bull move actually gets underway. Nonetheless, let's move on and talk the S&P 500. First off, Nick, what levels are you watching here for support resistance on the S&P?
Yeah, Patrick, this 4,000 level has been very, very key over the past few weeks, and it is the highest open interest for option expiration for March 17th, next Friday's monthly OPEX. So it has been a very key battleground for the bears and the bulls. And right now we're sitting just below it. If we break above it, next area of resistance would be 4120. And obviously the downside area of support would be at 3,800, which is about 200 points from where we are right now. Now, for the March 17th OPEX, we have an expected move of about 100 points in other directions. So 40.90 upside, 38.90 downside. I think we're going to see some upside before downside. Keep in mind, we do have FOMC in a couple of weeks, as well as CPI and PPI data, which should cause some serious volatility ahead. Now, Eric, what are your thoughts here?
Well, until Jay Powell hit the stage with his hawkish comments, it looked like a new uptrend was starting, and maybe we were going to take a run at 4,300 or so, which is the 61.8 moving average. And of course, that all comes after the 200-day moving average, which we discussed in detail last week, held as I think we expected it to hold. So here we are post-Powell. We still haven't retested the 200-day moving average. So in my mind, the technical tell here is really a pretty wide range. We've got to wait for either a daily close below the 200-day moving average, which is at about 39.50 right now, or we've got to see a daily close over 4080, which was the pre-Powell high. When we get that daily close, either above or below those levels, that'll tell us which way the next leg is headed. Meanwhile, I'm not sure. It's really a question of whether the Powell hawkishness is going to fade and be forgotten, or if it's going to set a direction for a new trend in the market. There's no reason, in my opinion, for so many people to have these continued expectations of a Fed pivot. I do think at some point that they'll reach a terminal rate and stop hiking, probably not until they break something, but I don't think they're going to start to cut until the market and the economy really tanks, and they're going to break things before we're going to see any reversal of Fed policy. So I don't know why so many people are still talking about expectations of a reversal in the direction of Fed policy. I think 50 basis point hikes are entirely possible. It will depend on the inflation data. But if inflation continues to run hot, I think we're going to see some 50 basis point hikes, and that's going to eventually break the back of both the market and the economy.
Yeah, Eric, I'm looking at very similar levels to you, but that 200-day moving average, I just put it on there just simply because it was tested so clearly, but also because the Fibonacci retrace zone also lines up perfectly with it. What will be interesting is obviously all eyes will be on this jobs data, and so many of our listeners that are going to be listening to the show will already see the reactions to here. I mean, to me, I continue to want to give the bulls the benefit of the doubt that they'll be able to make a punch back toward those February highs. But if for whatever reason the job numbers turn this market and we break below that level, then the level Nick was talking about, that 3,800 level, which lines up with the December-January lows, would certainly be the target zones for a breakdown move here. I'm still leaning and giving the bulls the benefit of the doubt here, but the job numbers are definitely going to decide what happens next. Anyway, let's move on here to page 5, where we have the chart here of the QQQ on the Nasdaq. What levels are you watching here, Nick?
Yeah, so looking at the QQQ for the March 17th OPEX, again, the expected move there is, which is for next Friday, is about 10 points in another direction. So upside would be around 307, downside 287. Key area right now is 295. Highest open interest right now for that expiration is 300 or so. And the upside right now would be to 313, which is the high from early February, late January. The downside from here would be down to 295, down to 285. So support first, that's 295, just below where we are right now. And then beyond that, 285 or so. Again, I do think we're going to test upside prior to seeing some more lows. But again, remember that we have FOMC and CPI and PPI coming out in the next couple of weeks, which is a lot of data to come out. That should cause a lot of volatility ahead.
You know, what I find interesting, Nick, is that when we go to page 6 and look at that VIX, for all of the market conditions being somewhat volatile, and more importantly, obviously so much upcoming news that could be market moving, the VIX remains at the bottom end of its ranges, and certainly we have not seen at least the market start to price in any big volatility premiums. What's your take here?
Yeah, so the VIX is interesting right now because, again, I mentioned last week that we're seeing suppression in the volatility index, likely because we're seeing less volume out a month or so. So the VIX is predicated on 30-day option expiration on SPX, on out-of-the-money calls and puts. And we're seeing a lot more activity on the 0-day contracts. So that's taking away from the liquidity of the 30-day expiration contracts. And so because of this, we're seeing suppression in the VIX. Meanwhile, we're seeing pretty nice whipsaw movements in intraday during market hours. But we're not seeing a lot of, and I don't know if you noticed this at all, is we haven't seen a lot of large gaps down or gaps up over the last few months. So again, VIX at 19.52 or so, denotes a roughly daily move in the broad markets of about 1.25%. But I'm not really taking too much stock in this, given that we're seeing a changing of the paradigm, or a paradigm shift, if you will, from buying 30-day expiration contracts for hedging purposes to buying 0-day contracts for hedging purposes, right? So that's taking away liquidity, and I think it's really affecting how you use the VIX to trade. Moving on to the dollar index on page 7 here. What are your thoughts here, Eric?
We're trying to break out now above the highs from January 6 and last week, approaching 106 on the dollar index. So it's pretty darn clear that the move down on the dollar has paused, if not reversed. So the question is, has the new trend become a reversal, like a new uptrend, or are we moving into some kind of a horizontal consolidation range where we're going to go up and down within a certain range? I'm leaning toward finding a range here. But when we thought maybe 105.5 was the top of the range, well, it looks like it's not that. Maybe it's going to be at least 106. I don't know where the top of the range is, but I think that's what we're in the process of doing, is finding a new horizontal consolidation range to probably carry the market for a few months. If this significantly turns into a new uptrend, and especially if we were to get all the way back up to, let's say, above 110 and start to approach new highs above the previous highs, that would be a really, really strong macro signal. I don't think that's happening, though. I think we're looking for a horizontal consolidation range. So let's stay focused on that until we have contrary evidence.
You know, for me, Eric, the dollar index breakout is a significant one because after a very shallow consolidation, one that could have easily seen the dollar index reverting back to 103 while seeing things like the euro making at least a couple hundred more pip moves, we're in a situation where the dollar once again resumed a bullish breakout on Powell's comments. The hawkish Fed could drive further short-term dollar strength. My views here is that there's a very reasonable chance that we're heading to the 107, 108 levels, and where we are doing a full retracement of the substantial decline that we've seen in the prior 6 months. Overall, for me to get really bullish the dollar, I think we'd have to already be in a much more turbulent stage of the market cycle, and that just clearly hasn't materialized. So, as we approach the top end of those kinds of ranges, we could see the dollar go into a consolidation into the summer, just like the trade range you were leaning towards. But I still think overall the dollar has lots of room for another bull run later this year.
Now on page 8, we have the chart of gold futures. What are your thoughts here, guys?
Well, as Louis and I discussed in the feature interview, what's very clear is that gold is being driven by the dollar index and Fed interest rate policy. It's not reacting, for whatever reason, to geopolitical fears. So despite the F-16s that are probably going to be sent to Ukraine and everything else that's going on, it really is going to be interest rates that drive this. And it seems to me that if we get more hikes, as Powell is talking about, particularly if inflation runs hot and we get a few 50 basis point hikes, it's going to mean lower gold prices. And as far as I'm concerned, the lower the better, because I see them as buy the dip opportunities. The support levels start at 1,800. I'm targeting 1,780. And maybe with hopes of a further dip to 1753, particularly if that was in reaction to a larger than expected Fed hike at some point in the next few months. All these levels are buys as far as I'm concerned. In my opinion, before 2023 is out, the Fed will succeed at breaking the market. Rates will come back down and gold should soar at that point. So if we got 3 more 50 basis point hikes before the market breaks, we'll probably get down to 1750 before gold bottoms and have an opportunity to buy at that level. And I'll be buying at all of these technical levels on the way down.
You know, Eric, those levels that you're targeting there are certainly the ones that my eyes are on as well. And that, in my mind, if we see that dollar index work its way higher toward 107, 108, 109, that allows gold to have another consolidation down to those kind of levels. But I'll be in your camp where I think it will actually offer a tactical buy on dip opportunity in those zones. While I generally remain quite bullish gold, my kind of view on this at this stage is that it's entirely possible that we're just going to see false starts and more range-bound price action in gold into the summer, and that a more meaningful rally in gold will be in the latter part of the year, but time will tell. Nonetheless, I wanted to just cover 2 quick charts, and the first one on page 9 is on natural gas, and we highlighted during these post games just that awful decline that we saw where natural gas prices went from $10 down to $2 on the downside. It's clear that we put some sort of a short-term low in, and so now the bigger question here is, will this establish itself as a basing formation, and or will there be any immediate bullish response? And while I think that nat gas can make a short-term advance up towards the $3.50 level, I suspect that it going into just from seasonality perspective, going into the summer, it's entirely possible that natural gas goes and retests those lows and establishes a base before a much more seasonally strong finish to the second half of the year. And on page 10, I just wanted to touch on that Treasury yield spread, the 2s10s. And what's interesting here is that it just continues to break down. We haven't seen these kind of deeply inverted yield spreads for so, like you have to go back to the like 70s and 80s to get things this deeply inverted. Obviously, many people suggesting that this certainly is calling for some sort of a recession. While I'm in that camp, I continue to think that this could stay deeply negatively inverted for many more months, because I think the real meaningful turn in this will only come once we're truly entering some sort of a recessionary phase. And so certainly while it's deeply negative, under 1%, it's something that I think will continue to stay down at these levels for at least the short term.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are in the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.